Hello and welcome to Market Outlook. This is Jeff Bish, president of MarketGauge.com, filling in for Keith this week. I also filled in last week, so I'm going to pick right up where I left off last week, and let's start with the four major equity indexes. I'm going to start with NASDAQ because last week we talked about the fact that the NASDAQ Broad Index, the composite, was just breaking out above its March highs for the year. It's a broader index, and we were looking to see if that would, in fact, continue its momentum, and indeed it did. And that was pretty much the story for the week. All the indexes ended near the highs, with the exception of IWM, right? So IWM, the Russells, a broader index, not only did it not end near the high of the week, but it was unable to close over its March highs. Now, in a different situation, we might call that a bit of concern, but given the fact that the Dow was so strong, the SPYs were so strong, the NASDAQ was so strong, I'm not going to get too hung up on the fact that IWM didn't make it, but we do want to keep an eye on that, and if we are going to find any weakness in the market, the first sign of that is most likely going to be IWM back down through this low around 118.90. So that's going to be a key level this week, 118.90 in IWM. I'm not going to spend a lot of time breaking down the individual indexes because what we really want to look at is whether or not we've got the breadth or the reason to believe that this is going to continue. Even if we pull back from a price perspective, we can only look at it as a pullback unless we can justify this as a blow off top. I don't think we're going to find that. One thing we will take a look at, let's take a look at, is the TLTs, the bonds. And bonds had a rough week. They had a rough week, but they're at a key level. Okay, so they broke down through this key 111 area. That said, they broke down in the Thursday end of the week range here. Almost straddles the breakdown level. So I would look at this particular day as a really important range. A breakdown below that looks like we continue lower. A breakdown above that, you've got pretty much a vacuum from this week, and it could be a huge head fake. Now, the breakdown in bonds actually is not necessarily a bad thing for stocks. It could potentially be a good thing for stocks in the sense that we had good economic data this week. For example, the end of the week payrolls, non-farm payrolls, were better than expected. So there's plenty of reason for bonds to be weak this week, which would be constructive for stocks. That said, looks like they may be a little overdone on the downside short term. So keep your guard up for a pop in bonds, even if it's only back up to the 50-day around 112. That said, that would be a counter trend move, not the best trend trade, but nonetheless, that's what we want to look for in bonds. Okay, so let's take a look at whether or not the move higher in stocks is a blow off, overbought, or potentially just the beginning of a bigger move. As we do each week, let's take a look at the McClellan. McClellan, again, a measure of breadth. And once again, I said it last week, I'm going to say it again, we've been saying it for weeks, it's going nowhere. Now, in terms of supporting a market going higher, it's not necessarily very supportive because it means the breadth isn't all there. On the other hand, it doesn't point to a market that's over exuberant and overbought. It certainly doesn't because, well, it's not. So in terms of market breadth, and this is across the board in all the advanced declines and up-down volumes, so I'm not going to go any further than this, it's nowhere. It's neither supporting it nor suggesting that it's overbought. The other measure we looked at last week was new highs, new lows. All right, so new high, new low on the NASDAQ front is still very strong in terms of the ratio. We were looking last week to see if it pulls below the 70 level. That would have been negative, but in this case it turned right around, went higher. It's bullish. I also pointed out that we wanted to see a high number of new highs if the market moved higher. Yeah, it didn't get up over the 250, but it did get over the 200. It's okay. All right, so I can't really complain about it. Could be better with more new highs. That said, it's going to take a little time for this to roll over. Again, if price pulls back, it's going to be a price pullback. It's not going to be a blow-off top, and it's not going to be a major divergent top in terms of new high, new low either. Let's take a look at the same measure for New York. And New York, I would argue, is actually good, not just okay. New York almost got up to 400 new highs. Definitely hit a new record in terms of the number of new highs for the year. So very constructive. And the new high new low ratio, as we measure it, well above 90. You can't argue with that. So from a market breadth point of view, new high new low, very constructive, and all we can say is good things about that. From a VIX point of view, so let's take a look at the sentiment. VIX, new lows. Again, this is the cash index. New lows for a long time, but we look to see whether or not it gets down to the lower Bollinger Band before we call it overdone. And we're not quite there yet. Definitely on the lower end of the zone. So what does this say? Complacency, which is pretty much in line with what I've probably written on the commentary leading into this. The bulls, in terms of the sentiment, the bulls aren't over exuberant. It's just that there aren't any bears. The bears have run away. There isn't a lot of bearishness, and this kind of falls in line with that. Complacency. There is complacency. Is it excessive? It's getting there, but it's not something we can pin a number on at this point and say we broke the number, we got a trigger, because we didn't. Finally, let's just take a look at the the staples versus discretionary spread that I looked at last week. And last week what I said was we're lower, and if the market moves higher, we want to see this thing push lower to support the bullish sentiment. And in fact, that's what it did. So here again, markets are moving higher, kind of in sync with what you would expect. If I were to sum all this up, I've got a situation where the markets are moving higher. They're generally bullish. They're not overbought. Maybe they're a little complacent. Could we pull back? Absolutely. Are we overbought and bubbled? I don't see it. The numbers just don't suggest it. So the other thing we looked at last week was gold and the relationship between gold and the TLTs. So here's that spread again, and as I pointed out earlier, TLTs really got hit hard. So if the TLTs get hit hard and gold holds up, then this is going to maintain a strong relationship, and gold would still look good on this. So TLTs get hit. You don't want that to be the only reason that gold holds up. And we'll look at gold in just a second on the next screen, and we'll see that gold did break out. And I said last week that if it breaks out, it looks like it could continue. It did break out. It's pulled back. We'll take a look at that. But this remains strong, and it remains strong. And gold held its level. And so that's still generally pretty bullish for gold. So let's go take a look at the gold chart. Okay, so last week we were looking for gold to break out above this consolidation area. In fact, it did. Friday's job numbers seem to pull it back into the zone, but as I pointed out, the interesting thing about gold is that while TLTs really fell apart, gold managed to hold. This is the level we want to see it hold, basically the 126.20 level. I'm going to call it the 126. I'm in it, and my stop is below 126. I'm in it on the breakout here, based on the same analysis that I went through with you last week. So, with all that having said, let's take a look at something different this week, and that is, let's take a look at some of the sector movement. What's leading, what's lagging? There was an interesting shift this week in terms of leadership. Now, I think I also said in the commentary leading into this, or asked, what do you think the strongest sector this year has been if you were to look at the 9 spider sectors? I suspect that many people would not have expected that particular sector, which was at one point up 18%, was in fact utilities. So if you look at this chart, this is actually a chart of the utilities sector in green, and it got hit pretty hard this week. So did the TLTs. So I put up this chart just to see whether or not the TLTs and the utilities were tracking this month. How correlated are they? And in fact, they've been pretty strongly correlated, and it'll be interesting to see, with the utilities having made a new high here and the bonds or the TLTs here not confirming that high, whether or not this represents a bigger picture top for the utilities. Now, first of all, utilities leading the market is not exactly what you want to see for a bull market leading, so I think it's okay for this to pull back. The other thing is, I'm not so sure the utilities were necessarily going up because of the interest rates, as you know. Not so sure it was just a grab for yield, which could be argued in certain circumstances. There are also people out there saying that the utilities have been somewhat of an energy play related to natural gas, which kind of makes sense if we look at the next chart. So what I've done here, I know it looks like kind of a mess, but it's really quite an interesting chart. This is the 9 sectors, the spider sectors. I'm just keeping it simple. And again, the green here is the utility. So you can see this is the strongest sector as of the 2014. The blue line here is actually the XLE. All right, so that's energy, and it has a high weighting of natural gas. So XLE, which is cooled off a little, if it's helped the utilities move higher, was one of the sectors that was weaker in the last couple weeks. And so maybe that's finally weighed in on the utilities, on top of the fact that rates got hit, or bonds got hit this week as well. Let's take a closer look at the change in rotation. But before I do, let me just point out, again, 6-month chart here. You've got utilities at the top. You've got XLE at the top. At the bottom here, you've got this gray line is the discretionary, consumer discretionary. Had a pretty good week. And so did the yellow line here, which is the XLF, financials. So let's just take a look at, this is the same, I'll take the same exact chart, but I'm going to look at it on a 5-day basis. Okay, now this is 5 days looking at 30 minutes. Green, again, is the utilities. So you can see the utilities really got hammered this week relative to everything else. And you'll also notice the yellow, which is the financials, the gray, which is the discretionary, the red here is technology. And we're going to take a look at some individual candlestick charts as well. Technology really had a strong week, led by the semis. And then the magenta is healthcare. Now, this is where I think it gets constructive. So you've got XLE, the weak on the week, utilities, weak on the week. They were the 2 strongest for the year. And you've got financials, healthcare, technology, and consumer discretionary. Now, if I had to pick sectors that I wanted to lead a bull market, it would be those 4. So the fact that they were strong for the week is actually somewhat constructive in my view. That said, let's just take a look at some of the candlestick charts on these particular sectors. And I want to look at the weeklies. All right, so let's just start with the ones that led. So here's XLU. All right, these are the utilities. You can see they got hit pretty hard, but after a long run. Let's look at XLE. Now these are weekly charts to give you some perspective. So XLE taking a break, but after a long run, a well-deserved break, and even if we were to pull back by 10, well, not 10%, but 5% would certainly mean nothing in terms of this last really strong leg up this year so far. If we look at what led this week, right, I started off by saying the XLKs, technology really led. Now that's getting a little extended in terms of price action if we look at it on a weekly basis, and you can see that's an awfully strong week. And if you consider the fact that it was led by semiconductors, it certainly had an extraordinary week to the upside on top of an already strong week there. My point here is how much further can this really go without at least a pause. The other one that had a strong week, XLF. All right, XLF is just breaking out, so that does look like it could have some room to run there. But again, it's on top of a strong run. The other one was the XLV, the healthcare. Okay. Again, this has had a nice move here. This isn't just breaking out. It's not fresh necessarily. And the last one was XLY, discretionary. Now, this one breaking out looks pretty good. So what I want to look at going forward, just kind of to support this discretionary, would be to take a look at the XRTs. Okay, that's the retail. This one has not really broken out yet, and perhaps if this can get going, it has some room to run. What am I suggesting here? That maybe if the XLYs and the XRTs can continue to run while the technology can perhaps pause a little just because it's run so long, maybe we can continue. From a price perspective, it just looks like a lot of things are extended. However, that said, we looked at the breadth. The breadth doesn't suggest that it's overbought. The sentiment, however, suggests that there may not be any bears around, and suppose that's bullish. The bulls aren't overly exuberant. They're more complacent. There isn't anything that really points blatantly to a overbought bubblish action here, except for maybe in some situations that the price action seems to be getting a little extended. That said, we really got to follow the charts, and I wouldn't be too quick to pick a top. So with that, I wish you a happy 4th of July weekend. Hope this helps, and we'll see you in the next video.